An Aussie expert is sounding the alarm about a potential market crash triggered by AI hype.
But to announce the largest AI infrastructure project by far in history, and it's all taking place right here in America.
We've also put a lot of investment into raw materials. We've built in South Texas and Corpus Christi the biggest lithium refinery outside of China, I believe.
Last week, Wall Street copped a reality check. The Nasdaq fell 4% from record highs. The S&P 500 dropped 3%. And leading the fall were the tech titans themselves. Meta, Microsoft, and others all dragged lower despite strong revenue numbers. Meta was hit hardest. Its third quarter report showed rising revenue, but also ballooning expenses on AI and taxes. The result? A brutal 20% correction in its share price. That tumble has left Australian investors wondering, is this just a temporary reset or the start of something deeper? AI researcher and former RBA economist Martin Eftimowski isn't waiting to find out. He's pulled his super out of the market entirely, keeping it all in cash. He claims he sees a bubble forming, and big tech's slowing earnings growth doesn't justify the hundreds of billions being poured into data centers and AI infrastructure.
All these tech companies are investing so much capex into this technology, and it's not a priori clear that this technology will achieve what they're trying to achieve. So let's put aside for a second the notion that AI and robotics is going to drive a new industrial revolution. I accept that without argument. That is a firm conviction that I have as well, right? But if you look in the 1800s, if you look at every industrial major jump, right, there's always a period of overbuilding where, excitement about the technology is overdone.
Instead, he argues, investors are clinging to what he calls a cute story, the promise that artificial general intelligence will solve everything. To him, betting on big tech today is no different from a religious conviction.
The level of volatility in the market has increased a lot, right? So if you think about what the volatility levels were like leading into this period, they were much more stable, and this is quite a lot of volatility that's basically out of nowhere.
He likens the Nasdaq dip to a dawning realization that these companies aren't any closer to earning back their AI spending, and that political shocks, like Republican losses in recent US elections, have rattled Wall Street's confidence. Mr. Eftimowski warns we're nearing what he calls a Wile E. Coyote moment, suspended over the cliff, looking down, but not yet falling. But not everyone shares his doom and gloom view. Vanguard's Duncan Burns says comparisons to the dot-com bubble are off the mark. Back then, investors were chasing companies with no earnings, just a .com at the end of their name. Today's tech giants are actually profitable, he says, and that makes all the difference. Mr. Burns admits US valuations are rich, but he says that doesn't mean we're in a bubble. It just means markets are more sensitive to shocks, and future returns may be lower. His message? Don't panic. After a decade of huge equity gains, he says it's time for investors and Aussie superholders to temper expectations, diversify globally, and focus on the long game. And as for the US government shutdown, history shows there's no clear link between shutdowns and market returns. Mr. Burns' final advice is simple. Avoid reacting to headlines and stay focused on your long-term goals.